Good evening, everybody. We're just going to be a moment to see if anybody else logs in for tonight's meeting. So if you can just bear with us for a moment, we'll get started in a minute or two. Not that many joining us tonight, looks like. All right. The ticker hasn't gone up, so I'm going to get started. Good evening. Thanks for joining us. Tonight's meeting is about our UFCW 1776 and participating employers pension plan. Before I get into introducing our guest, we'll go a little deeper into the topic for any members here tonight. I just wanted to be clear, we have two primary pension funds within the eastern part of the state that service members, mostly in the southeastern part of the state and a few other areas. One is the tri-state pension plan that a lot of our food industry people have been in over the years. The other is this one that we're talking about tonight. I just want to be clear, we are not talking about the tri-state plan. And the only reason I point that out is some of our members have experience in both plans because they worked for different retailers at different times. They bounced between the two. So to be clear, this is not the tri-state plan. This is the plan, let's just call it the other plan. And the purpose of tonight's meeting is to talk about some recent changes made. This plan's in good shape. Financially it's sound, and in today's world, there's a lot of pension plans that are troubled. You'll hear more about that from Joe Hicks tonight. But this particular plan's in good shape. With us tonight are some of the plan professionals that help us trustees manage the plan. There are an equal number of trustees from some of the contributing employers and from the union. And, one of the things we are worried about is when you look at especially some of the recent history with, the effects of the pandemic last year and how much the investment markets went down and what happened with the financial crisis of 2008, 9 and beyond. The recession of 2001, these moments in time have had dramatic impacts on pension plans all over the country. And currently we just I don't think our laws best protect the participants in some of these downturns. And there's too many loopholes as well where some companies get out through bankruptcy and other methods. So what we looked at this past year to help cushion some of the ups and downs of the volatility in the markets is ways to make this plan stronger, to make sure that the benefits that you're expecting are there when you finally retire, and therefore make it more secure for you. So we're going to take this plan in a little bit different direction, but one that we firmly believe is best for you and our contributing employers, so that the plan is sustainable and they can afford to continue to contribute to it and stay in business, and you can continue to accrue and earn benefits and feel more secure that those benefits will be there for you when the day comes. So with that, I'm going to turn this over to Joe Hicks from CBiz. He and his colleague Brian McCormick have both spent a lot of time helping come up with this concept and help us implement it. And for the next hour or so, you're going to get a presentation from Joe. So thanks again for joining us. And Joe, you got the
great. Thanks, Wendell. I'm going to share my screen here So welcome everybody, and thank you again, Wendell. I appreciate the opportunity to be here. As Wendell mentioned, we're going to take you over the course of the probably next 45 minutes or so, leave some time for question and answers at the end, over the plan changes, give you a little bit of background on what type of plan it is and multi-employer plans in general. Keeping in mind though, as you hear the presentation, certainly this is a discussion that the trustees have gone down and have spent numerous meetings, a number of months analyzing the pros, the cons of adopting this type of plan. They've spent a lot of time understanding the nuances of these types of plans. So tonight is meant to be an overview and a general education of how this plan works and the types of benefits that you can expect to receive and the types of communications that you can expect to receive. But certainly, if you were to try to review this presentation on your own, and we would certainly want to get a little bit more discussion and disclosure on some of the items that we're taking a look at here. So on this first page, just because Brian Sullivan is the fund attorney who is joining us tonight. He's here to make sure that if we get any tough questions, he's able to answer those questions for us. And certainly we just want to make sure that we're providing you the best information that we can with regard to the plan in this presentation. So with that, we'll jump right into the background. This plan is a multi-employer plan, and a multi-employer plan the structure is important because multi-employer plan is exactly what you would think it is. It's a plan with many employers. There are good reasons that funds adopt a multi-employer plan and that unions and employers adopt multi-employer plans. Most notably, you can see that these plans generally will share a similar geography or they'll share a similar industry. And one of the main benefits is that the expenses that are associated with a multi-employer plan are typically lower than those that would be associated with a plan that's not a multi-employer plan. So in this case, you might have 6 or 7 employers who would join together and adopt their own multi-employer plan. And in that plan, you would need one actuary, you would need one counsel, you need one administrator, so one accountant. So you only have the expense for each one of those professionals. Now, if each one of those employers wanted to adopt their own plan, they would have to hire their own individual actuary. So essentially, you'd have 6 actuaries, one for each plan. You'd have 6 attorneys, you'd have 6 administrators, you would have 6 auditors or accountants. And so by joining together in one group, you ultimately cut down on the administrative expenses. Administrative expenses, of course, would be something that would eat into the assets that are available to provide benefits. So in this concept, the employers, they band together and the union co-sponsors the plan, and the benefits are subject to collective bargaining with all of the participants and employers collectively sharing the risk that's associated with providing these benefits. So when we look at the multi-employer universe in total in the country, there are about 1,250 active multi-employer plans in the country, and they cover over 10 million participants. So this is a significant part of the overall U.S. retirement community here. And back in 2006, there was a law passed called the Pension Protection Act. And what that did is that created different zone statuses for all of these pension plans. That law required the actuary and the fund to look at their status, to look at all the funded position of that plan, and to put it in a color-coded position. That color coding is lots of times referred to as the stoplight coding, where you've got your green, your red, and your yellow, and these things mean exactly what you would think. If you're in the green zone, it's kind of the go zone. If you're in the red zone, it's the stop. If you're in the yellow zone, it's the be cautious zone. So when you look at the number of plans that are in the country and you take a look at where each of the plans sit, about 2/3 of all plans in the country are in that green zone. So these are plans that are projected to have good long-term funding prospects on an ongoing basis, and they don't have any additional funding requirements from the government's perspective. You can compare that to a number of funds that are in the yellow zone. There's about 10% of all funds in the country are in the yellow zone. About 14% of all funds are in the red zone. And then about 10% of all funds are in what we call the deep red zone. And those are those funds that are projected to actually go bankrupt in the next 15 to 20 years. So essentially, they're going to run out of money over the course of the next 15 to 20 years. We're happy to report, as Wendell alluded to earlier, that this pension fund, the 1776 and Participating Employers Pension Fund, is in the green zone. We'll talk a little bit more about its funded metrics and the measurements of the different funding statuses that we look at for the plan, but we are happy to report that the plan is in the green zone. When you look at the number of participants that are covered in each of these plans, about 6 million, approaching 6 million participants in the country are covered in green zone plans, and about 1.3 million participants are those that are covered in that deep red zone. So those plans are certainly looking at a cut of their benefits, at some point in the future, potentially. And again, adding on to what Wendell said in the beginning, this plan design is an attempt to try to make sure that this plan stays on solid footing and stays out of one of those lower zone statuses. So specifically, when we look at what type of plan it is, we talked about the plan being a multi-employer plan, but there are two major types of plans in the country, retirement type vehicles. One of them being a defined benefit plan, another being a defined contribution plan. And a defined benefit plan works just like you would think it would work. The benefit in the plan is defined. So the defined benefit plan attempts to promise a fixed retirement benefit so that as you work over the course of your career, you earn service credits. Each year you get an additional service credit and additional what we call benefit accrual. All those benefit accruals get added up so that when you retire, you have a total benefit accrual, and that's the pension that you will receive when you reach your retirement age and you elect to retire. How much money it costs to fund that benefit is determined by the actuary who follows the Internal Revenue Service and Department of Treasury minimum funding rules. So there are statutory rules that based upon the plan's assets and liabilities, a certain contribution has to be made. So in the defined benefit plan, we define the contribution, we define the benefit in defined benefit plan, and then we backsolve for the contribution or the amount of money that has to go into the plan in order to fund that benefit. A defined contribution plan works almost exactly the opposite. In the defined contribution plan, we define the contribution that's going into the plan, and then that contribution is going to grow in future years with investment return, or it could potentially decline with investment losses depending how the individual participants' investments perform or how the plan assets perform. And then the amount of retirement benefit is essentially going to be an account balance. So over the course of a working career, maybe your contribution is $1,000 or $1,500, and every time you put in $1,000 or $1,500 over the course of a working career, they're all going to add up. Over the course of a 30-year career, that $1,000 is going to add up in all of those annual increments. It's going to get investment return. It's going to be credited with potential investment losses if that's the way the market goes. And then when you reach retirement, you simply have an account balance. That account balance can be taken in most plans as a lump sum, or you could alternatively turn that account balance into an annuity and receive a monthly amount of income from that lump sum amount. Alternatively, you can take that lump sum and you can roll it over into a different retirement vehicle. So essentially, most of the types of plans that are in the retirement universe here are either going to be defined benefit or defined contribution. And the plan that we're talking about tonight is indeed a defined benefit plan. So what we're working with is a multi-employer plan that is a defined benefit plan. And for those that are following along on the screen, what I have up here is really just a graphical representation of what I just walked you through. For the people who are following along on the phone, I'll describe it so you can kind of visualize it. And by the way, this presentation itself is going to be saved out there, and you'll be able to view it through YouTube. And that information will be provided at the end of the presentation, where that link will be and how you'll be able to review the recording of this presentation. So what you're looking at here is essentially a participant's working career. Somebody would be hired and they're going to work a period of time. So from the time that you work until today, you have a benefit that has accrued. That benefit is what we call your accrued benefit. Under current pension law, once your accrued benefit is earned, you cannot have that accrued benefit reduced generally. So any benefit that you have accrued at any point in time, that is your benefit, you're entitled to that benefit, and nothing in this plan design that we're going to talk about today changes those rules. So your accrued benefit is your benefit at any point in time. The question is, if I've been working, say, for 10 years, and my benefit accrual was $10 per each year of service, my accrued benefit would be 10 times 10 or $100. That's my accrued benefit. If I have another 20 years to work, the question is, what is my ultimate benefit going to be? And that is what we call the future benefit accruals. And projecting those future benefit accruals are going to follow the plan document. So we're going to look at what the plan formula is, and we're going to work through that calculation. And what we're focused on today is how those future benefit accruals are ultimately going to be calculated. Once we calculate your accrued benefit, and your accrued benefit is determined at retirement, as I said earlier, you can start receiving your pension. You can take that pension on a monthly basis. You might choose to receive that pension over your life expectancy. You might choose to receive that pension over a joint life expectancy with you and your spouse. Certainly, you'll make that decision when you come to retirement. The plan itself, when we look at the plan and we look at the different risk measurements that are inside of the plan, one of the things we like to see is how mature the plan is, what the ratio is of its liability that we attribute to active participants versus the liability that we attribute to inactive participants. In a lot of funds that are struggling around the country, their inactive liability by far and away exceeds the liability associated with active participants. And essentially what happens there is the plan has gotten so big and it's so large and there's so many retiree payments, or there are so many participants waiting to receive the retirement, that it's not supported. Those benefits were not able to be supported by the current contribution base, which may have declined over the number of years. Again, as Wendell mentioned earlier, we're happy to report that in this plan is not overly mature. So what we see here on this page is a breakout of the total liability of the plan. The total liability is about $70 million, and about 40% of that liability is attributable to those participants who are currently active and currently earning service. So in a plan that would be overly mature, you might see 60 or 70% of that liability going to the retirees, and maybe only and the terminated vested participants, and a significantly less amount of that liability going on to the actives. So in this plan, we have about a third of the liability for retirees. We have about 30% of the liability going towards the terminated vested participants, and then about 40% of the liability going towards the active participants. So again, as we look at these internal metrics and we are trying to decide the long-term prognosis of the plan and the general projected health of the plan, this is a solid measurement of the plan's maturity level. Taking a closer look at that, what you're going to see now on the screen, and again, for those people who are on the phone, we're showing you a historical review of the value of the plan's liabilities. So when we do a calculation and we look at the plan's liabilities, we perform an individual calculation for every single participant in the plan. We look at their service, we look at their age, we look at the benefit they have accrued, and we assign a liability. Essentially, we say we need to have this much money put aside so that when this participant meets retirement age, we will have enough money to provide the benefit that is being promised. Back in 1995, the liability of the plan was right around $10 million. You can see that the liability over time has grown to about $70 million by the end of 2020. So over the course of the last 25 years or so, we've seen the liability grow in this plan significantly. Important to understand, though, that this is relatively predictable. Participants and the demographics that we see in these types of pension plans, they generally are, their life experience is generally very well predicted. So what we have to do in our calculations is we have to make estimates as to how long people are going to work, how long people are going to live, how long people are going to become disabled, how many people are going to become disabled, and we make assumptions. But the good news about making those assumptions is that all of those items, we can use a lot of data across a big portion of the population. And in general, when you look at a big portion of the population, you can really get some good statistics as to how long people are going to live, for example. and we're able to use those tables in order to accurately predict what's going to happen to the plan's liability. And the other thing that I'll say about this liability being predictable is you can see it's relatively a straight line. So if you were to put a ruler on the growth of this liability, you would see that that ruler was going to touch this line at a number of different places, meaning that it's almost a very linear growth in the plan's actuarial liability. And again, that's kind of what we would expect. When it comes to ensuring the future and it comes to measuring and mitigating and taking care of the potential risk that is in these plans, it really comes down to looking at the growth of the assets. So what you can see now on the screen is the yellow line that we put up on the screen here is the growth of the assets over time. And going back again to 1995, what you would see is that the assets exceeded the plan liabilities. When that happens, we say that the plan is overfunded, not in the sense that it has too much money, but in the sense that it has more than 100% of its accrued liabilities. And certainly that's an admirable place to be. You may recall, if you were following the investment markets back in the late 90s, there were some big run-ups in the investment markets back in the late 90s. And then in the early 2000s, we had 3 consecutive years that just were not very strong market returns. So the investment or the market value of the assets came back and came closer. Till around 2003, the plan was about 100% funded, so it wasn't overfunded any longer. And then it stayed 100% funded up until 2008, when again, there was a significant market drop. The general stock market, the measurement of the general stock market being the Standard & Poor's 500 index, dropped over 30% that year. This plan, most 401k plans that were invested in the stock market, most defined benefit plans in the country experienced similar market declines. And as a result, the plan starting in 2009 was again no longer 100% funded. But then you can see since 2009, over the last 10 or 11 years or so, that significant work has been done by the bargaining parties. And we've also had significant investment returns over that period of time. The plan now, we're happy to report, is back to being just over 100% funded in 2021. So the ups and downs in the market certainly is something that's harder to control than the ups and downs in the plan's liability. And the big question that the trustees face and that the other plan professionals face in advising the trustees is trying to figure out exactly what is likely to happen in these future years. So on the left-hand side of what you're looking at here is essentially a reproduction of the chart that we just took you through in detail. And you can see on the left-hand side, again, the volatility in the assets with the relatively predictable growth of the liability. The question is, if we had a repeat of that, how stable, how much secure can we make the benefits? And ultimately, that's what we're trying to get at with the change in the plan design and adopting this new benefit structure. When the trustees are trying to figure out exactly what to take into account, there are even more risks than just the investment return. As I mentioned before, we've got demographic risks. Will people live longer than we anticipate? So for example, a 65-year-old might be expected to live 20 years to 85. And if that participant actually lives 22 years to age 87, those are 2 years of benefit payments that we did not anticipate, that the fund was not already reserving money to pay. So in that sense, there would be more liability paid out than we had actually anticipated. So that's certainly a risk that we continue to manage and we continue to report to the trustees. We want to make sure that we're properly estimating how long people are going to live in this fund. In addition, you have the other economic types of risks. You've got investment returns, you've got inflation, and those types of things. And then you have the potential for bankruptcies from the contributing employers. If you have a plan that has 15 or 20 different employers and 5 of them go bankrupt and they're not able to pay their fair share of the liability, then the other employers in that plan are going to assume that liability in order to make sure that the benefits are going to be paid. So there are a lot of items that the trustees are looking to manage. And in a lot of funds around the country, The trustees really deal with these things on a very short-sighted basis, in my opinion. They look at what ultimately is minimally required as far as the contributions go. They look at the minimum regulatory compliance, and they just focus on those items. I like to think about the defined benefit plan like a credit card. You get your credit card statement, and there are a couple of key items on there. The first one is, what is the outstanding balance in your credit card? And certainly over time, in a perfect world, you would be able to pay down that outstanding balance so that you had no debt and your credit card would have zero debt. So let's suppose your credit card balance is $1,000. You certainly would want to have some sort of way and some sort of projection in your own personal finances as to how long it was going to take for you and what your plan was to pay down that $1,000. Similarly, a credit card has a minimum payment requirement. If you don't make that minimum payment, there are some fines, there's interest, there's some penalties. Defined benefit plans work exactly the same. There's a minimum amount required. If you don't make those, there are some punitive actions that are potentially assessed against the fund. And a pension fund is, of course, going to look at its unfunded liability to the extent that it has unfunded liability. So the trustees of pension plans really should be focusing on both the short term and the long term. The long term in a pension plan is not just, are the benefits solvent today? Are we 100% funded today? They really are, what are these benefits going to look like over the course of the next 20, 30, 40 years as our current population continues to work and they continue to expect to receive a benefit payment from this plan. So the trustees of this plan are taking that more long-term approach when we're looking at this new plan design. They're looking at the fact that the plan is 100% funded, and they're trying to figure out the best ways to keep that funding level at or above 100% funded while still providing a benefit that is appreciated by the plan population and has a high degree of probability of being paid, because you don't want to be necessarily in one of those plans that ultimately falls into that red zone or that deep red zone, and then some of your retirement income becomes put at risk. So as we work through this process, it certainly is collaborative between the employers. As Wendell mentioned, there are employer trustees, there are union trustees, the bargaining parties are all working, and everybody's collaborating here and trying to figure out the best way to manage all of these risks inside of this defined benefit plan, with those risks ultimately being the investment return, how long people are going to live, et cetera. Just to take one final step back before we talk about the actual mechanics and the actual change in this plan, this is a representation here. What you're looking at is a representation of the S&P 500, the Standard & Poor's 500 historical returns. And again, most people use this as a general proxy for the, quote, stock market. If you hear people talking about the stock market, generally a lot of people are thinking about either the Dow Jones Industrial Return or the S&P 500. And you can see that over time, if you were looking at this chart, there's been a lot of variability in the stock market over time. And so a good defined benefit plan is going to be able to absorb all of these ups and downs. And what the trustees are looking for here is a way to potentially, in the good years when the market is up, to provide an additional benefit automatically. So anytime that the fund outperforms what is expected, the participants will see a benefit increase. Anytime that the fund performs as we expect, everything would stay status quo. And if the benefit underperforms what we're expecting, then there's going to be a change in that future service accrual. Again, not changing anything from the past, but how you accrue benefits in the future would potentially change to the extent that there were market downturns. And as you can see on this chart, there were years where the general stock market was up close to or above 30%. In a number of these years, the market was up over 10, maybe even approaching 20%. But we do have those downturns that we talked about earlier, the 2000 through 2003, and then again the 2008 year. So in those years, those are years where necessarily the fund would want to pull back a little bit on the benefits that are being provided in order to make sure that the fund stays solvent and has enough money on hand in the future in order to provide the benefits that are being promised. So a general overview of how this plan is being designed and what sort of changes are happening in the plan is currently, there are a couple of different ways that benefits are accrued in the plan. The most prominent way is that a contribution is made on your behalf, and then your benefit accrual is a percentage of that contribution. So for example, a common multiplier in the plan is 3%. So if $1,000 is made in contributions on your behalf, your benefit multiplier would be 1,000 times that 3% multiplier. And so your benefit accrual for that year would be $30. $30 per month is what you receive for that one individual year. And that is the way that the plan operates currently. And what we're changing on an ongoing basis is how that accrual is going to be calculated in the future. Again, with the goal of trying to sustain the plan's funded position with changes to the future service multiplier. Now, to the extent that markets are up, and you're going to see that they have been up recently, and the participant benefits are going to be increased because of that, to the extent that the markets are up, future service benefits and those accruals are going to increase. To the extent that the markets fall below a certain level, then the future service benefits and how those accruals are calculated are going to be decreased. Again, and I can't say this enough, pension law does not require the plan provisions or the trustees to reduce the benefit that you have accrued generally at any point in time. So once you have an accrued benefit, the pension law says that's your accrued benefit and that is protected. There's nothing in this new plan design that changes any of that. And on an ongoing basis, we're only looking at what your accrual is in future years. And I'll walk you through sort of a graphical example of that shortly. So the big question, of course, that you're probably asking is, how then is my benefit going to be adjusted? I understand that it's related to the estimated market returns. How is that all going to work? Well, in order to not have the benefit moving up and down very sporadically and haphazardly, what we do is we look over a 3-year period of the investment returns. So we're not looking at just 1 year, and if the market is up in 1 year, we get an increase in the benefit. If the market is down, we get a decrease in the benefit. What we're trying to do is we're trying to smooth out those market returns so that your benefit accrual is a little bit more predictable. And what we do is we look at a 3-year average of those investment returns. And if that 3-year average is greater than a certain amount, then we will increase the benefit. If the 3-year average is between two items, and I'll talk about this in a little bit more detail in just a second, then the benefit will stay the same. And if that 3-year average is below a certain level, then that future service accrual is going to decrease. So numerical example, the 2021 accrual rate is already determined, and the reason it's already determined is because the 3-year averaging period that we're using is going to be the 3 years, 2017, 2018, and 2019. We already know what the market returns are for those years, and I'm going to show them to you in just a second. When we do that calculation, if that average return for those 3 years turns out to be less than the plan's assumed funding rate, which is 7%, then that future service accrual is going to decrease in order to try to hold on to the funded position of the plan, in order to shore up that funding position of the plan. If that investment return is between 7 and 9.5%, the benefit accrual is going to stay exactly the same. If that average return is greater than 9.5%, then the benefit accrual is automatically going to increase. So the logical question here is, I know why it increases, I know why it decreases, what's the point of that middle area between 7 and 9.5% when the benefit is going to stay the same? The point of that is we don't want to run this on a tightrope. We want to have a little bit of reserve. We want to make sure that just because we exceed our actuarial assumed rate of return of 7% by just a little bit, we're not going to spend that. We're going to keep a cushion here to make sure that the benefits that are accrued are going to be paid. And we're only going to start increasing benefits once we have what we would consider returns that are in excess of what we call a hurdle rate. So once you get over that hurdle rate, the benefits could, or not could, the benefits will increase on a future service basis. Taking a look at how those return bands are structured, as I mentioned before, if the plan is earned if the actual investment return for the 3-year period is between 7 and 9.5%, status quo, nothing changes in the plan. And what you're looking at on this page for the people on the phone is we have 3 columns here. The first column being the first end of the band for when a change will be made to the plan benefits, whether it be an increase or a decrease. The second column being the second end, sort of the end caps of that band. And then the third column is the change to the benefit that would happen if you fall into one of these bands. So for example, what I have highlighted on the middle of the page is that 7 to 9.5% band. And in the 7 to 9.5% band, if the investment return for the 3-year period falls into that band, then there is no change to the participant's future service benefit. If the 3-year average exceeds 9.5%, but is less than 12%, then the participant's future service accrual will increase by 12.5%. Okay, so a significant increase there in the participant's accrued benefit in the event that the investment return falls between 9.5% and 12%. So that's what happens from one year to the next. The following year, if we're going to do that same calculation for the next 3 years, your benefit starts at where we ended in the prior year. So in my example, if we had a 12.5% increase in your benefit accrual and we're going to decrease it because investment returns underperformed in future years, we start decreasing it from that 12.5% increase. So if you started with a benefit of $100 and it went up 12.5%, your benefit accrual would go up to $112.50. And then next year, if there's a required decrease in the future service accrual, then that future service accrual, we're going to start the decrease not from the $100 level. We started from the $112.50 level to kind of get back to even here. And again, with the overall concept being in the good years, the participants are going to share in that excess investment returns. And then in the down years, we're going to put the brakes on a little bit to make sure that any benefits that are accrued to date have an extremely high probability of being paid over time. So if we look at the actual calculation, and I alluded to this earlier, that we already know what the 2021 benefit is going to be. The accrual rate for 2021 is going to be 12.5% higher than the 2020 accrual rate. So the reason why we know that is because the 2017 investment return for the plan was 17.5%. The 2018 investment return for the plan was just a loss of just over 4.5%. And then there was a bounce back in 2019 of approaching almost 20%. It was actually 19.78%. When you 3-year average that of those 2017, 18, and 19 years, you get an investment return of 10.3% for that 3-year period. Since that 10.3% is outside of the status quo area, which was the 7 to 9.5% level, we fall into the benefit accrual increase. So on this next page, what you see here is I've highlighted in the middle of the page that 7 to 9% area. But for 2021, we already know that the plan's 3-year rate of return was 10.3%, and therefore we fall into that 9.5 to 12% category, which means that the accrual rate for the 2021 year is going to be 112.5% of ultimately what it was, or a 12.5% increase. So we're starting off this plan right off the bat here with a benefit increase. Now for 2022, 2023, 2024, and future years, we will do this similar calculation. The 2022 investment 3-year average is going to be based on the years 2020, 2019, and 2018. So we'll be able to perform that calculation, and the benefit accruals will ultimately be adjusted accordingly. If I were to summarize the overall the discussion and the overall mechanics of how this plan works, Keep in mind, you have an accrued benefit at any given time. January 1st, 2020, you had an accrued benefit in the plan. You understand what that accrued benefit is based upon your plan's benefit statement, based upon your interaction potentially with the fund's website. So you know what that accrued benefit is. That accrued benefit is not changing. Nothing in this new design changes that accrued benefit. The benefit earned during 2020 we'll take your 2020 accrued benefit, we'll add on the benefit earned during 2020, that gives you your 2021 accrued benefit. And again, that benefit is earned. Once earned, that benefit does not decrease. That benefit does not change. Your accrued benefit cannot decrease. From then on, we're going to look at this 3-year average, and we're going to look at what that future service accrual should be. So how those future service accruals are going to be earned, and they are going to be adjusted based upon the investment experience of the plan. Now, for conservatism and also for benefit protection's sake, there is an upper boundary on how high the benefit increase could get. So in the event that investment returns just went wild, we certainly don't want to overspend all of those investment returns. So there's a cap on the overall magnitude of how large that benefit accrual can get in any one year. And again, essentially just adding conservatism into the plan. And similarly, in the event that benefits or the investment returns were significantly down over a period of years, there's a floor as to how low those benefits can get, because ultimately the goal of this plan and the goal of the trustees is to provide a secure retirement and to make sure that this benefit ultimately is working for the participants and providing the benefit security that the participants necessarily need. In addition, we told you that the plan was greater at this point, slightly over 100% funded. Regardless of the mechanics of the plan, if at any given time the plan was less than 80% funded, meaning we only had 80% of the assets on hand compared to the liabilities, regardless of the mechanics, there will not be any increases in the benefit. And that's a reasonable approach, because if your plan is less than 80% funded at this point, the primary approach and the primary goal should be to secure those benefits and to secure that underfunding before you start to give out additional benefits for the future. So the trustees have built in kind of some guardrails here to make sure that this automatic adjustment of the benefit just continues to work. Keeping in mind that, the trustees, in their sole authority to provide and to interpret the benefits in the plan, they can always interact with this and they can make changes to that future service accrual as they deem fit. If the trustees, want to make a one-time increase to the benefits, they certainly can do that. If they want to pull the brakes on how the mechanisms are working or change the way this accrual is calculated in the future, the trustees, in consultation with the plan professionals, always have the ability to do that as well. And lastly, before we wrap up and open things up for questions, the way I really like to think about this is your benefit is earned as if you were walking up a flight of steps. Okay, so imagine you're on a flight of steps that is 30 steps high. Your accrued benefit at any time is the step that you are on. So if my working career was going to be 30 years and I'm on step 10 because I've worked 10 years, that's my accrued benefit. The way this plan works is that each time you earn a new accrued benefit, a new future service accrual, you're going to go up a step. The question is, how big is that step going to be? That step is going to be determined, how large that step is going to be determined based upon those 3 years of investment returns. And to the extent that the investment market outperforms what we expect, it'll be a bigger step up to the next year. To the extent that it underperforms, it might be the same size step, or it might be a lesser size step as you move up and you walk up those steps. The key is, as I've said a number of times, the accrued benefit, the step that you're on, never changes. So you never start walking backwards down the steps. You're always having something added on to your accrued benefit. And once you get to a new step, you're always going to be at that step or greater. The only question is how big each one of those steps is going to be. And for purposes of 2021, we're already aware that your step in 2021 is going to be 12.5% higher than your step was in 2020 because of those additional asset returns. What the future will bring will depend upon the investment returns that we see. So with that, we've put up the questions slide here. And as I mentioned before, that there's going to be a recording of this webinar that will be posted to YouTube. We've got the link here on the screen. For those that are on the phone, I'm going to read that link for you. So if you want to quick grab a pen and paper, you can write down that link, and I'll give you just a couple of seconds in case you didn't have that handy. The link is https://b as in bear, it.ly/fund office YouTube. So that's https://bit.ly/fund office YouTube, all one word, no spaces. So you'll be able to review this when you get your next benefit statement, or the first time you look at the benefits in this plan. It could be helpful for you to go back and review this presentation, and hopefully that'll help you understand the benefits in the plan and the changes that the trustees at this point are making. So with that, I certainly will open it up to any questions or turn things back over to Wendell if he has any additional comments at this point.
Thanks, Joe. And I know that was a lot of heavy material for everybody, but it is an important subject. At this time, I'd just like to see if either Brian McCormick from CBiz, Regina Reardon, our administrator, or Brian Sullivan, the fund attorney, has anything to add.
This is Regina. I'd just like to say thank you to Wendell for sponsoring this important webinar, and to our fund professionals for participating. We at the fund office are available to help you anytime you require assistance, so please do not hesitate to give us a call. We're there to serve you and to help you with all of your benefit needs. Thank you.
At this point, anything I would add would be to repeat what Joe explained. I hope the takeaway people have is that this was a very well thought out, careful step to make this plan more secure. While there's no guarantees that there won't be changes down the road, this puts the fund, which is the members' fund, it's their money, in better position to deliver on the promises of the benefits that they've earned to date and will earn in the future. It does so without the huge swings that unfortunately we've seen too often that can have devastating consequences for our members. And there's just too many places, including a few in our local, where pension funds have gotten in really bad shape. And by the time that happens, it's too late to do something like this. So the fact that we have a plan that's in good shape, we're able to add these features and modify it in this way to help it be more secure and improve the likelihood that people will get the benefits they earned. It's better we do it now than try and do it from the position of disadvantage when the fund is seriously underfunded and in trouble or even endangered. So I want to thank everybody here for the work they've put in. This has really been a years-long project. And the employers who agreed to go along with this, as it impacts them as well. But again, thank you, everybody. And at this point, I think it's important to open it up for questions.
All right, so we do have a question here, Joe. It says, do you have an estimate of what the 2022 accrual will be?
Thanks, Tim. I can actually jump in on that one. So we do have an estimate for what the 2022 accrual is expected to be, and right now we expect that accrual to remain the same as it was in 2021. So just to quickly walk through those numbers, Joe did lay some of these out earlier. The 2018 return was negative 4.65%. 2019 was almost 20%. It was 19.78%. And then in 2020, the estimate that came in was right around 10.5%. So if you average the 3 of those years, we're going to come up with a return in the 8s. So if you recall, the band between 7% and a 9.5% return over a 3-year period means that the accrual rate will not change. So said another way, the accrual rate had already went up last year to 112.5% of what it was normally, and it's going to stay there for this year. That's our current estimate. And I keep using the word estimate because we do have to wait for the final audit to come in, which usually comes in the 3rd quarter of the year.
Thank you. We do have another question. I heard the American Rescue Plan contained pension legislation. Does this new legislation impact any of this?
Yeah, so the American Rescue Plan Act made a number of changes that were significant for multi-employer funds. The most notable change that was made was the grant of special financial assistance to those plans that were in that deep red zone. Certain plans are eligible to receive a lump sum of money to shore up those the funding position of those plans. As we mentioned before, this plan is in the green zone. This plan does not have any of those funding issues. Therefore, by and large, this plan remains relatively unimpacted by the specifics of the American Rescue Plan. There are a couple of small items that will impact this plan, but the nuances of them, and they're so technically driven that they practically have, in fact, they have zero impact on the participant benefits. They're really actuarial issues. So I would say by and large, this plan remains relatively unimpacted by the American Rescue Plan Act.
Thank you. Last question looks like here is, does this impact the 401k plan?
It does not. The 401k plan is a separate and standalone plan. Certainly saving inside of a 401k plan is still a valuable component of every participant's retirement income and projected retirement income. But this plan and these changes specifically impact the defined benefit plan. There are no changes that this plan is making to anybody who participates in the 401k plan.
I think that is all the questions we have.
Okay.
Okay, great.
Well, I want to thank everybody for taking the time tonight. This is our 2nd night in a row, and I know it's taking you away from family, but I know our members appreciate the time you've taken to explain this to them. And of course, for any members on the call in this meeting tonight, feel free to call the fund office at any time if you have additional questions or concerns or just want to get a better understanding of it. And thanks again, everybody, and take care and be safe.